What's going on? Alex here, and today we're going to talk about the home office deduction and what impact it can have from a tax perspective. Now, why is this important? It's important because you can receive a tax benefit for using a portion of your residence, whether you rent or own it, for business purposes. So with that, I get a lot of questions about this topic. It's fairly common since we deal with a lot of small business owners that are either sole proprietors, meaning they do business under their own personal name, or they may have a single member LLC, which is also treated in very much the same way from a tax perspective. So we're going to do a bit of a deep dive into different scenarios that the home deduction can affect. And then from there, we're going to look at the numbers and see how they play out so that you guys can understand how it applies to the tax return. This is going to be split into two videos. So the first one, we're going to just look at the numbers and understand where they come from and how we calculate them. And then we're going to apply it to a tax return and look at some real world examples, if you will, to see how the numbers actually affect the returns. So with that, as always, I have a handy dandy spreadsheet ready for you guys. Let's take a look at it. Now, with the home office deduction, there are three important requirements to take into account before you can even think of putting this deduction on your tax return, okay? And essentially, there needs to be a portion of your residence, whether it's a part of a room or a room all by itself, for which you meet these three criteria. One of those being exclusivity. All right, so this area needs to be used exclusively for business. This can't be the family computer area. This can't be the desk where you have your personal laptop and you do business on it every so often. No, it needs to be an area of the residence that's set aside just for business. And when you're not doing business on it, there's nothing else going on. All right, and there was even a tax court case where children's toys were found in the room that was supposedly set aside for business purposes, and the deduction was disallowed. So that exclusivity requirement is pretty strict. So make sure that it's a separate desk or a separate room, and that there's even some sort of division between that area and the rest of the residence. That even helps to bolster your case for taking the deduction. So exclusivity is important. That's the first requirement. Second requirement is regularity. All right, so you have to use this location regularly for business purposes. It can't be somewhere where you use your laptop for an hour a year. All right, it has to be regular throughout the year. Now, there's no set specification as to how much that is, but it does need to be regular. So make sure that at least there's some sort of continuity in the use of that area exclusively used for business purposes. Okay, so we've got first requirement, exclusivity. Second requirement, regularity. Third requirement is that it's the principal place of business, which means that there's no other office that you have access to, no other location that you could do business out of, and that is the only address for the business, because as soon as you get that secondary office, the home office deduction goes away. It has to be your principal place of business, all right? So those are the three requirements, and stepping into the numbers, we'll get into a bit more detail here. We have to start with some assumptions, and in here, we're looking at a residence that's 1,000 square feet, and the total square footage of the residence exclusively used for business purposes, in this example, is 200 square feet. Now, clients ask me all the time, Alex, how am I supposed to determine the area used exclusively for business purposes? And I tell them, you literally have to measure the space, length and width, multiply those together, that's your square footage, all right? If it's a room by itself, measure the room. If it's a portion of a room, measure just that portion of the room, and you'll be all set in terms of determining the square footage used exclusively for business purposes. But again, don't forget regularity and principal place of business, three requirements. Once you have the total square footage and the square footage exclusively used for business purposes, then you can derive this percentage, which comes into play a little bit later. But in this case, we basically have the 200 divided by the 1,000, we get 20%. So 20% of the residence in terms of square footage is used exclusively for business purposes. Now, I got to tell you, we get a lot of clients telling us that they're using 80, 90% of the residence exclusively for business purposes. You got to take it easy with the percentages, because all of this ends up on the tax return when all is said and done. So if something looks silly in this area, the IRS is going to see it, and they may have some questions for you, and you may have some explaining to do. okay? So just make sure that this amount is reasonable, that it's real, that we're not making up fairy tales when we're putting on the percentage of the residence used exclusively for business. All right, let's keep it realistic. And the first scenario we're going to look at is a scenario where the taxpayer rents their residence. So they don't own it, they rent it. There are really two categories of expenses that go into the home office deduction, okay? One of those being indirect and the other one being direct. What's the difference? So the indirect expenses are those that apply to the overall residence, right? So in this case, to those 1,000 square feet. That's an indirect expense. Why? Because you get this entire expense, we're going to take a portion of it to represent the percentage used exclusively for business purposes, and that's how we're going to calculate the home office deduction portion, right? So these are the indirect expenses for that reason. And let's take a look at some of these. So we have rent in this case. The total expense amount we just made up to be $24,000. The renter's insurance amount in this case, also deductible expense. Let's say it's $250. Cleaning is at $2,500. And then repairs and maintenance are $1,500. Again, these are repairs and maintenance to the overall residence. We're taking an allocation of 20% of each of these based on this 20% that we calculated here. And each one of these indirect expenses gets allocated according to that percentage, which gets us to the allocated expense amount. So this is the amount of the indirect expenses after that allocation has been done. So we take the total, multiply it by the appropriate percentage, and we get the allocated expense amount. So moving into the utilities, it's very much the same story. We have power, water, and gas. Again, for the entire residence being, let's say, $2,000 altogether. Since it's an indirect expense, we multiply it by that 20%, and we get $400 in this case. The next one is a little bit controversial because depending who you ask and what tax professional you speak with, some may say that internet service expenses are included along with utilities. Some may look at it separately. It can go both ways, but in this case, we broke it out as a 20% allocation, so similar to the other indirect expenses, which gets us $300 of the $1,500. So you can see here that the total indirect expenses in this example are $31,750, and the total allocated expenses are $6,350. So we can check our math. So $31,750 times 0.2, we get the $6,350. So we're looking pretty good. Those were the indirect expenses. Now we move on to the direct expenses. So these are repairs in this example that were done just to that area used exclusively for business. That means it wasn't done to the overall residence. We went right into that room and installed some soundproofing or fixed a hole in the wall, something like that. All right, so those direct expenses do not get allocated according to that percentage that we calculated earlier. Instead, they get a treatment of 100%, so they're fully deductible. So indirect expenses get allocated, direct expenses do not. So you have to separate the expenditures into what was spent for the overall residence versus what was spent just for the area used exclusively for business purposes, and then you're all good to go. All right, so in this case, the total home office deduction comes out to the $6,350 plus the $1,500. We're at $7,850. Now, this doesn't mean you automatically get a $7,850 deduction on the tax return. We're going to take a look at that in an upcoming video as far as how it plays out on the actual return. But in this case, just know that preliminarily, the $7,850 amount is what we get in this rental scenario. Moving along, let's look at the home office deduction under an ownership scenario. So this is where the taxpayer actually owns their residence as opposed to rents it. This is a little bit more involved because we have to figure out what's known as depreciation. And depreciation is essentially expensing the cost of an asset over time, right? So you purchase the residence, you don't use it up all at one moment. You use it up over a period of a number of years typically, right? And we're going to take a look at how that works. So let's assume that the total acquisition cost of this residence was $700,000. That's overall, before any allocation. We're just looking at the total residence acquisition cost. We have to determine what percentage of the acquisition cost is applicable to the building versus the land. And there are a few ways to do this. And the reason we do this is that depreciation only applies to the building portion. We never depreciate land, but we don't know how much is each. So how do we determine that? Well, one way is to have an appraisal. An appraisal will tell you exactly what is allocated in terms of the fair market value to the building versus the land. So that's pretty straightforward, but sometimes you don't have an appraisal handy. What do? You can also look at property tax statements. But be very careful, because on the property tax statements, you'll find, let's say, for a $500,000 valued property on that property tax statement, let's say $400,000 goes to the building and $100,000 goes to the land. What we're looking for is the allocation percentage-wise between the building and the land. So if it's $400,000 the building, $100,000 to land, it's basically 80% building, 20% land. Those are the percentages that we're looking for from the property tax statement, not the value, because every municipality and every city, every state has different ways in which they calculate the value of the property for property tax purposes. So in our example, we're going to allocate 60% to the building and then 40% to the land, which gives us the 100%. And if we calculate those actual amounts, we get $420,000 for the building and $280,000 for the land, which arrives us at the total of $700,000, which makes sense. Now, the other consideration, and this rarely comes into play because real estate typically appreciates over time, but when you place into service a home office, you have to take into account the lesser of the adjusted basis or the fair market value of the residence as of the date placed in service. So let's say you go through this calculation and the cost basis that you arrive at is $700,000. But let's say the fair market value of the property on that date is $600,000. Well, for purposes of depreciation, you use the $600,000. It's the lesser of the adjusted basis or the fair market value as of the date placed in service. In this case, we go with the $700,000. Since the $700,000 is good, then that $420,000 is the number we'll use for the depreciation calculation. Moving along. Calculating the actual depreciation is pretty straightforward. For the part of a residence used for business purposes, the tax code says we have to use 39 years. We don't have a choice. Now you might say, oh, listen, my residence is built out of brick. It's robust. It's going to last forever. At least 100 years I should get. No. The tax code says it's 39 years, and that's what we have to use. And quite simply, if we divide the $420,000 by 39, we get $10,769.23. I know in the first month, people are going to comment. They're going to say, wait a minute, Alex, you're forgetting about the mid-month convention. In the first year, you only get 11 and a half months of depreciation if you place it into service, let's say, on January 1st. I know. Take it easy. We want to keep it simple. We want to keep it basic. So just know that we're disregarding the mid-month convention in this example. We don't want to get too involved with the depreciation part. We're just looking at the home office deduction. But just know that that's out there. So in the first year, your depreciation is going to be a little less than this $10,769 if you put this in your tax software. That's due to the mid-month convention, but we're disregarding that for now. So on an annual basis, we're expecting almost $11,000 in depreciation, which is a non-cash expense. It's a tax benefit generally, so it's a beautiful thing. All right, so now we're going to look at those home office expenses again, but in this case with the ownership scenario. So a lot of the numbers I try to keep the same so that there's apples to apples comparison between the rental ownership scenario. So in this case, we have the mortgage interest at $24,000 instead of the rent. In the rental scenario, we had at $24,000. Now, keep in mind, this is mortgage interest. These aren't your total mortgage payments. Every mortgage payment consists of some interest and some principal. So if you just lump your mortgage payments into this number here, you're making a mistake. You're already starting off with the wrong numbers. We don't want the principal. We just want the mortgage interest. So pull out your Form 1098. It'll have your mortgage interest on it. That's the number you want, not the total payments. And we get to the $4,800. Again, we're using the 20% because that's the square footage of the residence, the percentage used exclusively for business, square footage wise. So we also have property taxes in this example. Notice in the rental scenario, we did not have property taxes, which makes sense, right? Renters just pay their rent and the owner of the property pays the property taxes. So in this case, we're paying the property taxes. Now I know it's imputed in the rent. I realize that, but here we can break it out separately. So let's call it $5,000. And again, we're allocating it to the 20% percentage that we calculated earlier. And the math works similarly as before. Now we have homeowners insurance here instead of renters insurance. Not a big difference. We get cleaning, repairs, and maintenance. A lot of those same expenses. Now on the utilities side, same amounts. So power, water, gas, $2,000. Internet service expenses, $1,500. Again, we allocate all of the indirect expenses, and we get $73.50 in terms of the indirect home office expenses. Now let's look at the direct expenses. So we have the repairs, again, 100%. We fix something in that area exclusive use for business, so we get the full deduction there of the $1,500. Now adding that all together, we get the $73.50 plus the $1,500. $88.50 is our total deduction when we take those direct and indirect expenses into account. But wait, we also have the depreciation that we talked about earlier, right? So the $10,769 we calculated right here. We add that to the total deduction, and what do we get? $19,619, it's about 23, okay? Which is quite a bit different than the rental scenario where we only had $7,850 in terms of a deduction. So if we look at the overall difference just between those two scenarios, and again, I try to keep a lot of the numbers constant, what's the difference? There's $11,769 in additional depreciation on the ownership side. So ownership has its perks, especially in the land of home office deductions. So with that, this is how it plays out in a handy-dandy spreadsheet, but it's really helpful to understand how this plays out on the tax return itself because there are a few quirks into how all of this works. Now, that's going to be the next video, but in the meantime, I want you guys to think about and put in the comments what happens to all of this additional mortgage interest and property taxes that we're not deducting in the ownership scenario, because we're only deducting $4,800 of the mortgage interest, which is $24,000. We're only deducting $1,000 of the property taxes, which are $5,000. So what happens to those excess deductions? Do they just go away? Can you deduct them somewhere else? Drop it in the comments below. Let me know how much you guys have been paying attention. And next video, we'll point out who's got it right and who needs to watch more of these videos. Hopefully that was helpful. And if you have additional questions about the depreciation side of things, there's an entire video that I made called Selling a Real Estate Property or something very close to that. You can check that out. There's a detailed analysis of how the depreciation works, and it includes the mid-month convention and all that good stuff. So with that said, thank you guys so much for watching. I'll catch you on the next one. If you haven't subscribed to the channel, and I know a lot of you have not subscribed, hit that subscribe button right now because there's amazing content coming and a lot of it. All right. As always, hopefully this was helpful. Thanks for watching.